people have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing. When everyone says there's a top, there cannot be a top. Keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now, that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
In every market cycle, there comes a moment when uncertainty becomes louder than reality. Sentiment swings, liquidity tightens, price action stalls, and suddenly, the narrative shifts to fear. Today we're hearing it everywhere. The top is in. The boom is over. AI stocks are rolling over. Crypto is dead money again. But here's the irony. When the entire market becomes convinced that a peak has already formed, history tells us that moment cannot mark a true top. Tops form when investors are euphoric, not when they're fearful. And right now, fear is dominating the conversation. That's exactly why Fundstrat's co-founder and head of research, Tom Lee, remains bullish. He's not ignoring liquidity pressures, the temporary wobble in equities, or the uncertainty around the government shutdown. He sees those, but he also sees the bigger structure, a macro setup where inflation is softening, visibility for AI remains intact, and the Federal Reserve is inching closer to confirming an easing cycle. If that December rate cut drops, the implications are massive: momentum for small caps, momentum for tech, and yes, momentum for crypto. Because historically, when financial conditions loosen, crypto rallies the hardest. Despite price fatigue over the past few months, Lee argues that this hesitation is not a sign of weakness. It's a setup. Institutions are massively underexposed, caught flat-footed, and trailing benchmarks into year-end. Risk assets, particularly crypto, remain underallocated. Liquidity returning to the system favors sectors tied directly to growth expectations and innovation. That's Bitcoin. That's Ethereum. That's digital assets closely tied to technology adoption cycles. Lee's message isn't about short-term volatility. It's about positioning for the inflection point that everyone else is too afraid to see. And in this interview, Tom Lee lays out some of his strongest forward-looking calls yet. He explains why the fear-driven narrative is broken, how a major AI-driven supercycle parallels previous decades, and why the biggest mispricing in the market may now be in crypto. So if you're investing in Bitcoin, Ethereum, or anything in digital assets, this is exactly where you should lean in. Make sure you like this video, subscribe, and stay to the end, because Tom Lee is about to reveal critical insights about the next major leg higher for crypto. If you're serious about building real long-term crypto wealth, then you need more than just an exchange. You need structure, security, and smart strategy. And that's where iTrust Capital stands out from the crowd. iTrust Capital is the platform designed for investors who want to grow their crypto tax advantage portfolio while having full control. With a self-directed crypto IRA or their premium custody account, PCA, you can invest in 80+ top cryptocurrencies, physical gold and silver, and trade them all 24/7, seamlessly, safely, and simply. Here's why thousands of crypto investors are making the switch. Tax advantages that help you keep more of your gains working for you. 1% transaction fee and no monthly fees, cost-efficient wealth building. Institutional-grade custody that puts asset security first. 24/7 trading access to all supported assets. Multiple funding options. Rollover, transfer, ACH, and even in-kind crypto transfers. Fast setup. You can sign up, fund, and start investing in minutes. And this part is important. iTrust Capital eliminates the slow, outdated, and overly complicated systems of traditional IRAs. No more paperwork headaches. No more friction. Just a clean, easy way to move your money into the assets you believe in most, safely and legally. And here's a great perk for getting started today. When you sign up using the link below and fund your new iTrust Capital account, you'll receive a $100 funding bonus. It's an easy boost to kick off your investing journey. Just use the link in the description to claim it. So if you want your crypto strategy to scale into something bigger, smarter, and built for the future, check out iTrust Capital through the link in the description. It's the platform designed for investors who want to grow, not just speculate. Thanks, and enjoy the video.
Well, I think what people have a hard time understanding and grasping are super cycles, because Fundstrat's work by nature is thematic. We look for story arcs that last 10 to 15 years. So the reason we turned structurally bullish in 2009, was because our cycle work showed that there was a long-term bull market starting. Beginning in 2018, we identified two future super cycles. One was millennials and the fact that they're entering the prime age workforce. That was a powerful tailwind that would last up to 20 years. And the second was there was a global prime age workforce labor shortage. I know it sounds like plain vanilla to say that, but that was going to set the stage for an AI boom. So we're in the midst of an AI boom that is causing prices to levitate. But this is pretty textbook. In 1991 to 99, there was a labor shortage and tech boomed. 1948 to 67, there was a labor shortage and tech boomed. So tech is booming, and a lot of people look at stocks that have a high Sharpe ratio, right? They're just going up, and they assume it's a bubble. And so people have been chronically trying to short NVIDIA every step of the way up. And then the second thing people anchor to is that, well, many people aren't really that old in our business. I was actually an equity research analyst during the dot-com boom. So many people are saying this is just like the dot-com mania. There's some similarities, but we're so far from it. But everyone thinks that this is big again. I was actually helping doing the wireless sector. So they were part of that build out of the fiber and the cellular towers and the internet. I remembered that data networking analysts asked me, Tom, what is TCP IP? Because, wireless companies had to do some basic architecture. So this is very different because AI, of course, is gaining function. Internet wasn't gaining function. There was just a lot of spending. So the thesis in telecoms back then, because people forget, because telecom was the CapEx boom, not internet. In the emerging markets, telecom spending was associated with GDP growth. So there was an emerging markets thesis around telecom spending that was in the mid-90s. But then that spilled over into the US digging up a lot of fiber everywhere, on the railroads, on the streets. Many people were young, but they, Quest and everybody was laying fiber, and then they were laying fiber across the world with Global Crossing. The problem is internet consumption of that was not at all keeping pace with the explosion of the amount of fiber being laid. There was almost 99% dark fiber at the peak. Now, NVIDIA GPU usage, as you're saying, is pretty much 100% usage the minute they turn it on. It's a lot more like the Cheesecake Factory, where when Cheesecake Factory opens a store, it's at 98% capacity.
If NVIDIA could increase capacity by another 50%, they would still sell out of every single chip.
That's right, because as you know, today there are three really binding constraints. It's NVIDIA chips, it's actually silicon surrounding it, and then it's energy, and all three are constrained. And then it's really maybe not the best word, but the gain of function of AI is actually progressing faster. So there really right now is capital spending is behind the curve. Well, number one, as your viewers know, people have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. And every time the S&P is down 2 or 3%, or AI stocks are down 5%, I think people get really cautious. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing. When everyone says there's a top, there cannot be a top. The top in the dot-com was because nobody thought stocks could ever fall. They actually thought we were entering like an era of continued prosperity. The second thing to keep in mind is that markets have been strong for the last 6 months. There is incredible demand for equities because people are really off sides. That's what you have to keep in mind. In April of this year, people thought we were facing Armageddon because of tariffs, and you had many economists proclaiming a recession, and that's how institutions traded. They were actually positioned for a massive bear. They can't fix that in 6 months. So we're now getting into year end where institutions, 80%, are trailing their benchmark this year. It's the worst performance for institutional fund managers in 30 years, and they have 10 weeks to fix it. They're going to be buying stocks. And finally, visibility for AI has not even been affected by the government shutdown or anything. So companies are going to start, as they think about 2026, start making announcements. So I think in the final months, I think one surprise is the AI trade's going to come back strong because it's wobbled. But the Fed is getting people scared because was the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
Tom Lee's core argument centers on something most investors struggle to recognize in real time: super cycles, not hype cycles, not bubbles, long structural arcs powered by demographics, labor dynamics, and technology. Lee identifies the 2010s onward as the beginning of a sustained bull market, driven by the rise of the millennial workforce and a global shortage of prime-age labor, a setup that naturally fuels innovation. Today, AI is the dominant beneficiary of that structural imbalance. And despite concerns of a bubble, Lee argues that high performance and strong earnings are telling a different story. This is not the dot-com era. Back then, supply outpaced usage. Now, demand outpaces capacity. GPU cycles refresh every few months, not every few decades. That's why attempts to fade NVIDIA have failed repeatedly, and why risk assets, including crypto, continue to benefit from the same underlying secular forces. With that context established, Lee shifts from the macro engine to the market mechanics. Institutions entered 2024 positioned for recession. They were preparing for Armageddon, not acceleration. And because they positioned so defensively, 3 years in a row, they remain massively offside as markets grind higher. This isn't just a miscalculation, it's a structural deficit in positioning. And as Lee notes, institutions have less than 10 weeks to fix it. That pressure doesn't just lift equities, it spills directly into crypto. Because when money managers chase performance in an easing environment, they rotate into assets with asymmetric upside. That's the setup, and it leads naturally to what Tom Lee breaks down next: what Bitcoin and Ethereum can realistically achieve by year end.
Well, I think people have dampened their expectations for Bitcoin partly because Bitcoin's been treading water, and there have been a lot of OGs, original Bitcoiners that are selling above 100,000. But it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year. I think it's a big ask. But to me, what's more obvious is Ethereum can have a huge move into year end, because even Cathie Wood wrote about it. She thinks stable coins have been cannibalizing demand for Bitcoin, and gold and tokenized gold is cannibalizing demand for Bitcoin. But stable coins and tokenized gold run on smart contract blockchains like Ethereum, and Wall Street is building, and Larry Fink wants to tokenize everything on the blockchain. That means Ethereum is where people are starting to raise their growth expectations. And if you're raising your growth expectations, then your discount to the future is going up. So I think that there's a bigger move in Ethereum, and Mark Newton, our head of technical strategy, thinks we can be like 9 to 12,000 by January. I think that's about right. I think Ethereum, just 3,600 more than doubles between now and year end, or between now and January.
Do you think that that also spills over to cryptocurrencies as far as Ethereum and Bitcoin, that institutional participation?
Yeah, I do, Tom. One thing you're pointing out, and that's correct, is that 2025 is the third year where the S&P will be up double digits, probably up 20% this year. So 3 years of 20% gains in a row. Okay, remember at the end of 2022, people were saying we were Armageddon. Nobody was bullish. So in the last 3 years, wealthy individuals and hedge funds recommended people go to cash, or they do alternatives like private equity, private credit, or venture. But the S&P 500 has trounced all of those categories of assets. This is a comeuppance because, 3-year return, what is someone's excuse for basically maybe having flat performance or up 15% when the S&P is almost, up 200%? So this is really the reason 2026 is probably not as bearish as people think, because now next year, I think people are going to be like, wow, wait, NVIDIA and all these are public companies and their earnings are growing 50%. I think people are going to actually start chasing them next year. That's really positive for crypto because, as you know, there is also this argument today that the crypto cycle is a 4-year cycle, so it should be ending now. So people are trying to fade that. I think people are trying to fade everything, the S&P and the crypto, but forgetting that the Fed is beginning to cut. And the ISM, and we've written about this, is more correlated to Bitcoin than monetary policy. And until the ISM gets to 60, Bitcoin really can't peak. So I think this is pretty positive for crypto. But crypto, it's kind of been hurt because, monetary liquidity hasn't been really increasing. The Fed has been under QT, quantitative tightening. Yep. That's ending in December. And the Fed hasn't really given clear signals that they want to ease. So I think there's been a little bit of confusion for investors. I would say if I had to say what is the most overrated risk, I think the most overrated risk is that inflation's coming back. But the reason I think it's overrated is I think too many people think monetary easing cycles create inflation, or they think GDP growth creates inflation. But inflation is a very mysterious thing because we had a lot of easy money for years and there was no inflation. And now that the labor market's softening and the tariffs basically were supposed to create another wave of inflation, it hasn't, and housing is now tanking. How do we get inflation if the big drivers are housing? The big drivers of inflation are housing, labor costs, and then goods. But none of those are inflating. I heard a Fed speaker last week say core services is inflating again. We checked it. That's dead wrong. PCE core services is now running at 3.2%. It's been long-term 3.6. It's actually running below average. And core services generally runs above 2% because goods offsets that. So I think that there's a false belief inflation is actually strengthening.
What about a curveball that comes from oil? Let's say geopolitics, wars, supply chain, oil shoots up. Could you see a scenario where this makes you bearish if that happens?
There is a possibility. Oil, if it goes high enough, can create a shock. And so if you look at the last 3 cycles of shocks, inflation shocks, the last 3 non-Fed related economic shocks were commodity shocks. But oil has, as a burden, has to become meaningful to households. So, in the last few years, the energy intensity of the economy has actually shrunk. So oil needs to get close to 200 to create that shock. $100 oil, we got close to that. It doesn't create the shock. You really need to be getting. So could oil triple on a geopolitical? Maybe. But remember, this summer, the U.S. bombed Iran's nuclear facilities. And people had said that if the U.S. ever bombed Iran's nuclear facilities, oil would spike to 200, and it barely budged.
Tom Lee believes expectations for Bitcoin have become too muted. The narrative has turned overly cautious because Bitcoin has moved sideways, and some longtime holders have been taking profits above $100,000. But that doesn't change the structural truth. Bitcoin is still one of the most under-allocated asset classes in institutional portfolios. And in an environment where the Fed turns dovish, liquidity bottoming coincides with one of Bitcoin's strongest historical tailwinds. Lee even suggests Bitcoin could reach the high $150,000, possibly even $200,000 by year-end, an aggressive target, but one grounded in positioning dynamics, liquidity normalization, and a broader resurgence in risk appetite. But the even bigger story, in Lee's view, may be Ethereum. He points to something many investors are missing. Stablecoins and tokenized assets are quietly siphoning demand from Bitcoin, not because Bitcoin is weaker, but because everything built on-chain is scaling rapidly. This rising demand for tokenized value, smart contract rails, and on-chain settlement directly ties to Ethereum's growth expectations. When growth expectations rise, valuations expand. That's why Fundstrat's technical strategist Mark Newton projects Ethereum between $9,000 and $12,000 by January. That's more than a doubling from current levels, and Lee believes that's entirely reasonable given the macro backdrop, institutional pressure, and the accelerating timeline of blockchain adoption across Wall Street. Traditional investors have spent 3 years positioning defensively, missing growth, missing innovation, missing crypto. This creates a reflexive dynamic heading into 2026. As institutional capital rotates and retail sentiment improves, crypto markets stand to benefit disproportionately. Combine an easing Fed, stabilizing inflation, and an accelerating AI-driven productivity boom, and suddenly, digital assets are set up to outperform just as the consensus is turning fearful. Lee even debunks one of the most overhyped risks, resurgent inflation. Housing is softening, labor costs are cooling, and even core services inflation is below long-term averages. Without meaningful drivers of sustained inflation, the Fed is more likely to ease, even if geopolitical noise or oil fluctuations cause temporary turbulence. So what does all this mean? It means that the crypto market is entering the championship rounds, where conviction matters, not noise, where positioning matters, not sentiment, and where the biggest gains historically emerge when investors finally realize they've been fading the wrong trend. Tom Lee argues that the supercycle is alive, the AI-led structural boom is intact, and crypto is positioned to be one of the biggest beneficiaries. And drop a comment below. Do you agree with Tom Lee's outlook for Bitcoin and Ethereum? Or do you think fear still has the upper hand? If you're still watching, make sure to hit the like button, subscribe. Thanks for watching, and see you in the next one.